Good day, grade 10s. I'm going to be going through the corrections of task 10.11, 12, 13, and 14. And then your work for the new week will be on task 10.15, which you will find on 281. So let's get going. So they say the following is an extract from the pre-adjustment trial balance of Topple dealers. So it's a pre-adjustment. What does pre-adjustment mean? It means that this is our balances before the adjustments has taken place. On the 30th of June 20.5. So they've given us interest on fixed deposit, rent income, and commission income. So let's go through the adjustments. Adjustment number 1. Part of the building has been let since the 1st of January 20.5. The tenant pays rent monthly in advance, i.e. the July 20.5 rent was paid in June. Make the necessary adjustments. Adjustment number 2. The interest on the fixed deposit is 11.25%. The investment was made in July 20.3. Interest has been received for 9 months only, and they've given you a note. The fixed deposit agreement stipulates that the interest be paid directly into the bank account of Topple dealers every quarter. Topple dealers sells certain products on behalf of another business. For this, they receive a commission. 280 has been received in advance. So what have you got to do for this business? You need to prepare journal entries for the adjustments. You need to post to the general ledger, and you also need to calculate the amount of the fixed deposit. So let us work out our adjustments first before posting to the journals and ledgers. Alright, so adjustment number 1. They said part of the building has been let since the 1st of January 20.5. So now remember, dates are very important. We started renting out our building the 1st of January 20.5. That is when this person moved into our building. Now you need to ask yourself, when does your year end? Your year ends the 30th of June 20.5. Year end. Okay? So they told us that the tenant pays rent monthly in advance, i.e. the July rent would have been paid in June. So you can already see that we have 1 month in advance, because when does our year end? Our year ends in June. Let me just put that here. Our year ends June. Anything over this financial period is considered your next financial period. Okay, remember, we are only interested in the current financial period. And again, what principle are we making use of? The GAR principle, matching. Everything that falls in our current financial year should be taken into account. Anything out of the financial year should not be taken into account. Alright, so let's start. How am I going to work out this adjustment? I'm going to have a look at the balance which they have given me. The balance for rent income is 8,400. Alright, now you need to divide by the number of months that the person has paid the business. Alright, so if he moved in the 1st of January, okay, here's my timeline, January, and he has paid for July as well. We need to count how many months is that. January, February, March, April, May, June, July. So in total, he paid 1, 2, 3, 4, 5, 6, 7. He paid us 7 months. And of that 7 months, 1 month is paid in advance. So you're going to divide by 7 months. Why am I dividing by 7 months? Because I want to know the actual amount per month that we receive. So let's look here. It is the 8,400 divided by 7. So our rent that we charge this man a month is 1,200. 1,200. So of this rent, 1,200 rand has been paid in advance. All right. Then we're going to work out the next adjustment. The interest rate on the fixed deposit is 11.25%. Okay, so the interest has been interest rate on the fixed deposit is 11.25%. The investment made in July 20.3, the interest has only been received for 9 months. And then they say to you, the fixed deposit agreement stipulates that interest be paid directly into the banking account of Topple dealers every quarter. Okay, so I am going to take this out just to make some space. Okay, so we know that the rent per month was the 8,400 divided by 7. You know where we got the months from, okay? You had to do your timeline. So the rent that has been received in advance was 1 month, and that was worth 1,200. I am now moving on to the interest deposit, the fixed deposit. So they say that our investment made in July, and they pay us out every 3 quarters. What does 3 quarters mean? I mean, every quarter it means 3. Every 3 months we will be receiving interest from these people. So again, we're looking at our interest on fixed deposit. For the year, it worked out to be 4,050. 4,050. Okay, so that's what you should have been receiving from your interest for the full year. All right, but they are saying that some of the income is still due to you. All right, so you're going to divide this by 3. Why am I dividing it by 3? Because quarters represent 3. So let's just have a look. We took this out in July. Okay, August, September. That is when the first interest would have been paid out. So July, August, September, October, November, December, January, February, March, April, May, June. So this has not yet been received, and it becomes, what is the new account that you learned? Income receivable. So the first adjustment was income received in advance. The second adjustment is income receivable, income that you still need to receive. All right, so if I say 4,050 divided by 3, it's the quarter. Remember, every 3 months you should get your interest. And if I work that out, it should be 1,350 that should be received always. So 1,350 would have been paid there, 1,350 there, 1,350 there, and then 1,350 over there. Am I right? Okay, so obviously, what does this tell you? Let me just see here. It should be like this: July, August, September, October, November, December, January, February, March, April, May, June. That's how it's supposed to be every 4 months. Apologies, but from those 4 months we have the 3/4. 1,350, 1,350, 1,350. So if you add all that interest up, it will give you a total of 4,050. Okay, so again, income receivable 1,350. That should be your income that should still be received. Okay, moving on to the third one. There is no calculation there. They have given us the figure, so we don't have to work it out. So let us go and post this to our journal, our general journal. Okay, so we're gonna have journal voucher 1. Okay. Okay, so journal voucher number 1, and it will be the last date of the month, which is 30th of June. I am going to be posting the income receivable first, and you will see why. So the income receivable, remember what is income receivable? What type of account is your income receivable? It was given to you last week. It is an asset. All right, money that's still coming in, 1,350. Where's that money coming from? It is coming from your interest on your fixed deposit. Interest on fixed deposit, and that will be your account credit, because that's the actual income that should be coming in. And remember, when you post into your GJ, you will always have a narration explaining the transaction, so your reason explaining what just took place. So what just took place: interest on fixed deposit, still owing for 3 months. Okay, that's a little bit of a long narration, but you will have space. Okay, it's got nothing to do with any debtors or creditors. That is why we will leave those columns blank. Moving on to our second journal voucher entry. It's also on the 30th, so we don't have to put that into account and be repetitive. So what is the next account that we are dealing with? We are dealing with our interest that had, not our interest, our income that has been received in advance. So these two have been received in advance. Let's do it. So I put rent income and commission income that was given to us in advance. Remember, what is income that is received in advance? It is a liability. Received in advance. I do not have enough space, but you would put interest, income received in advance. So it is a liability. It's money that should be received only in the next financial year, but was received in the current financial year. So how much of our rent has been received in our current financial year? We worked it out to be 1,200. I'm putting it on the debit side because I cannot record it as an income as yet, only in the next financial year. Please remember that. We will do the reversal once the next financial year reflects. And that was 280. Okay, so the reason why I started off with income receivable, because there was only one entry over there, and I'm ending off with income received in advance because I'm adding the rent income as well as the commission income to get a total of all my income received in advance for that current financial year, and this should give me a total of 1,480. And your narration would be rent income, please do not abbreviate, and commission income. What happened? Received in advance. Alright, I hope that makes sense to you, grade 10s. Nice and easy. Alright, now we're moving on to our general ledger. Alright, so now remember that the balance sheet consists of your liabilities, your assets, and your owner's equity. Owner's equity being two only, which is your capital and your drawings. Your nominal account section consists of owner's equity only, and that would be your incomes and your expenses. Alright, so yes, we did have assets and we did have liabilities. The two accounts that we've identified was our income receivable and our income that has been received in advance. Alright, so that's the first one I'm doing, income received in advance. Okay, there's not a lot of space here, as you can see, so I'm just going to highlight that for you, income received in advance. So what is income received in advance, ladies and gentlemen? It is a liability. It is not your money until we are in the next financial year. And there are two accounts that we've established that has been received in advance. And that was your rent income and your commission income. Okay, I am putting it on the credit side because liabilities go on the credit side. Which journal did we take it from? From your GJ, your general journal. Again, liabilities increase on your credit side and they decrease on our debit side. So we'll just put these entries down here. You all know where we got it from, and that's that. You will then total up 1,480. Our next balance sheet account which we've established was the income receivable, the income that should be received in this current financial year but has not yet been received. And that, ladies and gentlemen, is the asset that you will be recording. And remember, assets increase on your debit side. So again, dates is very important. Do not forget your date. What is still being received? It is your interest on your fixed deposit. Please do not abbreviate. And that was 1,350. Moving on, your nominal account section is to do with your incomes and your expenses. So we know that we're getting an income from our interest on our fixed deposit. Okay, so you'll put your total. Remember, in your nominal account section, it's total brought forward. Firstly, we had a total, remember, that total was 4,050. This was on the 1st of June, 20.5, and then on the 30th, we established that it's income receivable that we still need to get, income receivable, GJ 1,350, and that's that. Moving on to your next one, your rent income. What do I do with incomes? I credit incomes. We had a total brought forward of 8,400. Okay, and then we received income in advance. It's not income for this current financial period, and therefore we will put it on our credit side. 30th of June 20.5, income received in advance. And we work that out to be 1,200. Okay, and then you'll do the very same for your commission income. You'll put down my total, which was 24,540. And then what did I receive in advance? That was the 280. GJ, income received in advance. Please do not abbreviate. I am doing it just because I have no space. All right. I am now going to move on to task 10.12, and at this point you had to analyze the above adjustments under the following headings: account debit, account credit, and then the effect on the accounting equation. Alright, so I'm just going to draw that over here. In your books you would have had the template. It's assets, owner's equity, and liabilities. And then account credit and our account debit. So let's have a look at these transactions. The following is an extract from the pre-adjustment trial balance of Pelham Suppliers, whose financial year ends at 31st of December 20.1, and they give us the opening balances. And then they say that the fixed deposit amount consists of two investments, which is 30,000 Rand each. So here's our fixed deposit, and you can see 30 plus 30 is 60,000. One was made on the 1st of July 20.1, and the other was made on the 31st of December 20.1. Interest earned on both investments is capitalized. What does the word capitalized mean? It means that the interest made from that investment will then be added on to the investment. Alright, there are two options where interest is not capitalized and it gets paid into your bank account, or it will be capitalized and it doesn't get paid into your bank account but goes straight to the fixed deposit. Okay, so what does this tell us? Interest is capitalized, meaning that your fixed deposit is going to be increasing. What is the two accounts that we have, that we are basically dealing with? It's fixed deposit and interest on fixed deposit. So remember, a fixed deposit is an asset, and every time an asset increases, it will be on your debit side. So what is actually increasing? The fixed deposit is increasing. What is being paid out into the fixed deposit? Your interest on your fixed deposit. And why am I putting that on the credit side? Because it's an income. Interest on fixed deposit. Now I'm asking myself, what is going to happen to the accounting equation? My assets is increasing by how much? Okay, so we have to work it out. Alright, so please note, your financial year is very important. The first investment was taken out on the 1st of July 20.1. So you had this investment now for 6 months before the financial year ended. Alright, the second investment was taken out on the 31st of December 20.1. Okay, and when does your financial year end? It ends on the 31st. So no interest has gained on this investment as yet. However, there was interest that was obviously gained on that. So let me just show you the calculation. It's going to be 30,000. Reason why I'm only taking the 30,000, because that one investment is worth 30,000. There is going to be no interest on this one, so it's not worth it for me to calculate. So 30,000 times, how long did I have this investment open? For 6 months. So I'm going to say times 6 over 12, and I'm going to multiply it by the rate. Here's the rate, 12.5% per annum. All right, so if we work that out, 30,000 times 6 months times 12.5%. The interest that we have received is 1,875. 1,875. So going back to our journal, our assets is increasing by 1,875. And remember, interest on fixed deposit is an income, and incomes increase on your owner's equity. 1,875, and there will be no effect at liabilities. Moving on to number 2. Part of the premises has been let to the tenant since the 1st of July. The rent increased by 150 on the 1st of December. The tenant already paid the rent for January 20.2. So now it becomes a bit tricky because there has been an increase, and because of the increase you can't divide by the number of months that rent has been received. All right, you cannot. You're gonna have to first subtract the increase and then divide by the number of months. All right, once you have the month amount, you can then add back the increase to figure out how much has been received in advance. So I'm going to say that again. Due to the increase, you cannot divide by 7. An extra 150 was received in December and January. So we're going to have to first subtract the increase from the rent income and then divide it by 7 to determine the amount received in advance. We will then plus or add back the increase for the rent in January to determine what has been received in advance. So let us work this out. Okay, firstly, your month timeline is important. When does your financial year end? Your financial year ends the 31st of December 20.1. Anything after this is in your next financial year. I'm only interested in my current financial year. So they said part of the premises has been let since July. So we've let out our premises on the 1st of July 20.1. So this is in our financial year. So this person has paid us July, August, September, October, November, December, and also for January. So that is 1, 2, 3, 4, 5, 6, 7 months. So previously I did say that you need to divide by the number of months that the person has paid for, but the increase makes it tricky, as I said. All right, so you need to first find out what is the increase. It's 150, and the increase was from the 1st of December. So the increase has taken place in December and January. So there was 150 and there's 150 increase. So we have to subtract that increase. So we look at our rent. Our rent has 13,040. 13,040. I am going to subtract the increase. Remember, why am I getting the 300? I took it from December and from January. All right. And that will give me 12,740. Now I can divide it by the number of months because the increase has been taken out, and that should give me a value of 1,820. I'm going to add back the general increase, which will now give me a total of 1,970. This is now the actual amount with the increase. This 1,830 was before increase, which the person has been paying from July to November. But in December, the 1st of December, there was an increase of 150. So this man has paid 1,970 Rand in advance. And remember, income received in advance is a liability. It is not your money until the next financial period. So let us go and post it. What is income received in advance? It's a liability. That is why it will be credited, because liabilities increase on the credit side. Income received in advance, and obviously what account came from this income that was received in advance? It was the rent income, which will be debited. Usually we credit our incomes, but because this is not in our current financial period, we will debit it. Okay, we worked out how much was received in advance. Our liability will increase by 1,970, and our owner's equity will decrease by 1,970. We should not receive it in that year. No effect at assets. Moving along to the commission income, 160 for the state. The commission income amount includes commission received for 20.2. What is our financial year? 20.1, which means 20.2 is out of our financial year, and it is 1,410 Rand. So no calculation is needed. Commission income will be debited because this is not the income for the financial period. Okay, and then again, income received in advance. Zero minus, they've given it to us, 1,410, and then plus 1,410. I hope this is getting a bit clear, it's becoming a bit clear to you. So let's move on to the next one. Provide for the depreciation. I love depreciation, and I hope that you're getting into the flow of things when it comes to our depreciation. So now remember that depreciation, there are two methods to the madness, and the methods are cost price and the diminishing balance method. So cost price, also known as the straight line method, you'll take your cost price and multiply it by the rate immediately in order to get your depreciation. If you think of a lion, a hungry lion that cannot wait to eat, he is going to pounce the prey almost immediately. So that is how cost price is. You just take your cost price and immediately multiply it by the rate in order to get your depreciation. The diminishing is the longer method. Diminishing method. This is when you first have to work out your carrying value. And how do I get my carrying value? I have to take cost price, subtract accumulated depreciation, and then that will give me my carrying value. Carrying value times the percentage rate, which will then give me the depreciation. Alright, so with the diminishing balance method, it is a patient lion. will first suss out. You will eliminate the strong prey, all right, because you're always going to look for the easiest kill. So you'll subtract the strong prey, which is your accumulated depreciation, in order to get your carrying value, the weak prey. Once you have that carrying value, you will then pounce on that prey to get what you want, your depreciation. I hope that analogy makes sense to you. All right, so let us work out our depreciation. Provide for the depreciation as follows. Vehicles 25%. Note the vehicle was bought on the 1st of January 20.1. All right, so it makes things a bit difficult, the note, because they're saying that. Why does it make it difficult? Because you didn't have it for the full financial year. You have to work out how long you had it for. So if I bought it on the 1st of January 20.1 and my financial year ends the 31st of December, how long did I have it for? Let's count. From January, February, March, April, May, June, July, August, September, October, November, December. Are we right here? So in total we had this vehicle for 12 months. So it's not really tricky. We'll just work out the cost price of the vehicle, which we would have gotten there. So I'm going to say 180 times the percentage rate is 25%, and that will give me 180 times 25%, 45,000 rand. Right? So remember, depreciation. What is depreciation? It is an expense. What does expenses do? It will then depreciation, and then we'll have, sorry, depreciation is an expense, so it is debited depreciation, and then accumulated depreciation on vehicles. You have to be specific on vehicles. Okay, so it will be minus on your assets, because your assets is decreasing in value, and minus at owner's equity, because that is a cashless expense. And you'll do the very same for the next depreciation. You can already add your details into account debit and account credit because it's already given. Okay, and that was now on equipment. Alright, so let's work this out. This is on the diminishing balance method, so it is a little bit a longer process. Is it? No, it's still on cost, so we're great. Additional equipment costing 10,000 was bought on the 31st of March 20.1, and this has been recorded. Okay, so you have, this one is a bit tricky. So whatever you gotta do, you're gonna have to subtract that 10,000 rand out to work out your old equipment. So 50,000 minus 10,000, okay, which is gonna be 40,000. Okay, let me just see if I'm correct. Yes, I am correct. So I'm taking the cost price of my old equipment and I'm gonna multiply it by the 20%, which will give me a value of 40,000 times 20%. It will be 8,000 rand. And now I'm going to work out the depreciation on that new equipment, which was 10,000 times the 20%. But you need to know that you need to calculate the number of months which you had it for. So they told you that you've purchased it the 31st of March. So you will work out from April, May, June, July, August, September, October, November, and December. 1, 2, 3, 4, 5, 6, 7, 8, 9. You had it for 9 months. And this will give you a value of 1,500 Rand. So your depreciation was on old plus the new. You're going to add that together to get a total of 9,500, and that will be 9,500 and then 9,500. Subtract. All right. Moving along to the post-adjustment trial balance, which they've given you. You'll just say your rent income, open bracket, it was 13,040, but you've received 1,820. Okay. All right.